Yes, I guess you can see it's a luxury situation to be in, but demand has been much stronger than what we and the market in general foresaw, especially in the automotive segment, but also to some extent in other smaller areas. We are now struggling to deliver to customers. We are doing it, but the value chains are much tighter than what we foresaw. And going into the second quarter also, based on the bookings we see so far, this strong demand continues. There is no signs of slowdown. This is probably a combination of many elements. In the start, it was probably a lot driven by pent-up demand. You have been running down inventories during the COVID situation, but now we are also seeing underlying positive developments in the fundamental drivers exacerbating this movement. So much stronger than what we expected, and this will also impact our earnings going forward.
Let me just pick you up on one comment you just made about value chains being much tighter. What have you seen over the course of the quarter in terms of raw material costs, and what kind of raw material cost pressure do you expect for the coming quarters?
That's a good question, and especially relevant for our industry these days. We are a fully integrated producer, and what we see now is that the integrated margin for producing aluminium in Norwegian krone especially is the highest level we have seen in a very long period in time. So we are in a fortunate situation where the LME price is moving much more than the cost curve. We're pricing well above the 90th percentile. We have started seeing some push on raw materials, but if you look at, for example, the aluminium price, that market is still well supplied, and the gap between these two drivers are still large.